The American economy has found its footing after a summer recession scare. But much of the Midwest is still stumbling. President Trump campaigned in 2016 on a pledge to restore jobs, manufacturing jobs, specifically to long straggling Midwestern communities, and he has made the economy a centerpiece of his re-election campaign. But job growth has slowed sharply this year in Michigan, Pennsylvania, and other states that were critical to Mr. Trump's victory in 2016, as well as in states like Minnesota that he narrowly lost. Hiring in the region has remained sluggish, even as it has picked up this fall in much of the rest of the country. Other economic measures show similar weakness. The states are struggling in part because they depend heavily on manufacturing and agriculture, two sectors that have been hit especially hard by Mr. Trump's trade war. Tariffs have driven up prices for imported parts and materials and pushed down demand for American goods abroad. There's been 3 instances where the dashboard has turned yellow, but economic growth reaccelerated and went back to green 1995, 1998, and 2016, he said. We think all 3 of those would have been a recession, but the Fed recognized weakness and provided liquidity to the economy, and it reaccelerated from there. Furthermore, Schultz predict that if the United States economy does tip into a recession next year, it will not be a severe one. The past 2 recessions were caused by a historic real estate bubble and one of the largest stock market bubbles in history, he said, adding that this has caused investors to think of recessions as severe outcomes that will necessarily lead to multi-year bear markets. A better comparison would be the 1990 and 1991 recession, which led to just a 0.2% decline in GDP in nominal terms versus the 3.3% decline following the Great Financial Crisis. A recession of this magnitude may not be of much concern to buy and hold investors, as it led to a market decline of roughly 20% between July of 1990 and October of 1990, losses that were regained by February of 1991. Trump inherited a buoyant economy and then gave it a sugar rush of income tax cuts and corporate giveaways. Stellar growth last year prompted the United States Central Bank, the Federal Reserve, to increase interest rates to calm things down. A combination of those higher borrowing costs, the end of the sugar rush, and the tariff war with China, which has increased import costs, has hit United States industrial production. Figures last week showed the United States manufacturing sector in decline for the first time in a decade. Trump, fearing the economic slowdown will damage his re-election hopes, has berated the Fed for being slow to cut rates again. Last week, United States steel, which the president believed would prosper once it was protected from cheap Asian and European imports, said business was so bad it will be laying off workers, and its stock value slumped back to where it was before Trump's election victory. Signs from the international money markets are mixed. Stock markets in the United States and Germany remain at historically high levels, but bond markets are more jittery. Investors who lend money to the United States government via the bond market have sold their short-term loans in droves in expectation of an imminent recession, much as they did before the 2008 financial crash. The bond market never lies, especially about the path of the United States economy, say many analysts, fueling even more speculation that United States economy could be in dire trouble as early as next year. The savior could be the Fed, which might cut interest rates back towards zero, allowing index companies and households to breathe a sigh of relief. That said, it will only kick a final reckoning down the road to the moment when bad debts reach level that neither banks nor government can cope with. Data is coming at investors from every angle, with so-called recession indicators flashing signs of an economic slowdown brought on by slower growth abroad and the United States-China trade war. A slowing global economy is pressuring central banks abroad to lower borrowing rates at precedented levels, and a tit-for-tat tariff war between Washington and Beijing is weighing on business sentiment. Assessing these indicators is not easy, and many economists, money managers, and analysts disagree about how healthy or unhealthy the United States economy really is, and whether its long expansion can continue. Here are some major recession indicators that are flashing red. The Economic Policy Uncertainty Index, an index designed to measure policy-related worries around the world, hit its all-time highest level, 342, in June. The EPU index tracks the amount of times newspaper articles use buzzwords related to economic and political uncertainty. Additionally, it measures the number of tax laws set to expire and the spectrum of disagreement among economists. The more dissent, the higher the index goes. The index simmered in July to a level of 280 on hopes the trade deal between the United States and China will be resolved. The labor market and the broader economy are both better than they look on the surface, and in fact have been mostly defying in continual patter of recession expectations. By multiple measures, the United States is staying ahead of the global slowdown, the trade war with China, and the bond market's implication that the decade-long recovery after the financial crisis coming to a close. Though the major Wall Street average wobbled around break-even Tuesday, stocks are back near records high as investors shrug off the wave of fear. One gauge is particular shows how much the economy has defied downbeat forecasts. The economic slowdown in China and President Trump's trade war have created a lot of uncertainty around the globe. And that means businesses are waiting on the sidelines instead of moving ahead with investment. But the United States economy has been doing well, and growing last quarter, job growth has been steady, and unemployment is at a historic low. And the stock market is at a record high, suggesting some degree of investor optimism. So one big concern is whether bad signs overseas will frighten United States consumers and businesses into holding off on big moves that will in turn slow the United States economy down. The Citi Economic Surprise Index, after nearing its lowest level in 2 years in June, this week was at its higher point since February. The index looks at actual economic readings against consensus forecasts, so it will rise when expectations are too low and fall when optimism runs too strong. The latest move, then, can be seen as a recalibration of Wall Street's overriding pessimism. Central banks, including the United States Federal Reserve and the European Central Bank, have recently announced interest cuts in an attempt to stimulate activity, but the United Nations report was pessimistic about the chances of success. The slowdown in growth in all the major developed countries, including the United States, confirms that relying on easy monetary policy and asset price rises to stimulate demand produces, at best, ephemeral growth, while tax cuts for corporations and wealthy individuals fail to trigger productive investment. Unconventional monetary measures such as negative interest rates and creating money through quantitative easing remain the go-to policies for addressing weaknesses in the global economy, even though they have had a weak record since the financial crisis. Trade growth was expected to slow sharply this year as a result of a slump in global demand and the protectionist measures announced by Donald Trump. The United Nations stressed the need to look beyond the short-term threat of recession to deeper and long-running threats. Beyond the immediate risks that could stall the global economy are a series of macro-structural challenges that predate the global financial crisis and have gone largely unattended since then, the report said. It added that 4 issues stood out due to their degree of interdependence. The smaller share of the economies precedes going to labor, the erosion of public spending, the weakening of investment, and these unsustainable increases in carbon dioxide in the atmosphere. A continued climate protection requires a massive new wave of investment, reinventing energy and other carbon-emitting sectors. New low-carbon technologies must be created, installed, and maintained on a global scale. The report also highlighted increased green investment, which it said will be a significant source of income and jobs. Recent discussions call this strategy the Green New Deal, recalling the 1930s New Deal, which tackled unemployment and low wages, the predatory nature of finance, infrastructure gaps, and regional inequalities in the context of recovering from the Great Depression. Most of the idea, comment, information, and criticism containing in these videos have been created by Daily News Report. Before making any important investment decision, use the information contained in these videos as a starting point for conducting your own research. If you make any investment or legal decision, it is advised to consult an expert before making this decision.